Reinsurance. It refers to insurance purchased by an insurance to provide protection against some or all certain risks of the insurance policies issued by the insurer. Moreover, in exchange for the assumption of these risks, the insurer receives payment in the form of reinsurance premiums or allowances from the direct writer of the business, the insurer. Next, from the perspective of the insurer, the direct writer of insurance policies, reinsurance provides for a transfer of risk to the reinsurer. Furthermore, the extent of the transfer depends on the specifics of the reinsurance agreement or treaty. It is important to note that reinsurance also creates risk for the insurer. Next, reinsurance exposes the insurer to the risk that the reinsurer defaults on its obligations through insolvency. Types of reinsurance. A reinsurance agreement between an insurer and a reinsurer is called a reinsurance treaty. There are few types of reinsurance. Firstly, excess treaties or quota share treaties. Secondly, indemnity treaties or assumption reinsurance. Thirdly, proportional reinsurance or non-proportional reinsurance. Lastly, automatic reinsurance or facultative treaty. Firstly, indemnity treaties. Most treaties are called indemnity agreements, and such agreements are binding only for the companies. Moreover, the policyholders of the insurer have no contractual relationship with the insurer. For example, we need to sign an indemnity agreement with a skydiving company. By signing, the indemnity agreement protects the skydiving company against any lawsuits. Secondly, assumption reinsurance. Assumption reinsurance entails the permanent transfer of insurance liabilities to the reinsurer. Furthermore, policyholders are notified that the assumption reinsurer has assumed the legal responsibility for the business and that all future premiums and claims are to be the responsibility of the assumption reinsurer. Proportional reinsurance and non-proportional reinsurance. Proportional insurance provides for the cession of a portion of the coverage by means of a formula based on the ceding insurer's retention limit. For example, all amounts of life insurance in excess of the insurer's retention limit will be reinsured. There are common proportional reinsurance techniques would include: firstly, traditional coinsurance, used for life insurance products with a savings element whereby all risk and policy elements are shared with the reinsurer, including the investment risk. Modified coinsurance, similar to traditional coinsurance except that the insurer retains the investment risk, and yearly renewable term (YRT) cover, whereby the insurer reinsures a specific risk, such as mortality, in exchange for yearly renewable term premium. Secondly, non-proportional reinsurance provides protection that depends on the claims amount experienced. For example, stop loss or catastrophe reinsurance. Firstly, automatic reinsurance. An automatic reinsurance treaty allows an insurer to cede risks in excess of its retention limit automatically to its reinsurer subject to predetermined conditions. Secondly, facultative treaties. Facultative treaties require that the reinsurer approve each risk before it assumes any liability for the risk. This latter treaties tend to be used for the larger, more complex to underwrite risk. Thirdly, excess treaties. Excess treaties provide for risk and in excess of the schedule of retention limits to be reinsured. Lastly, quota share treaties. Quota share treaties provide for a fixed percentage of each risk to be reinsured.